bóyá àwọn náà mute gbogbo wa.
Ẹ̀gbọ́n, mo ń lọ fún 2 minutes báyìí. Báwo ni sà? By 2. It's 2 minutes to 2.
Good afternoon, coordinator.
Good afternoon, sir. Mr. Felix Akintola. Good afternoon, sir.
Good afternoon. God bless you.
Yes, please.
Good afternoon.
Good afternoon. The session will start shortly. Please be patient.
All right, no problem.
Oh, Seba on mute.
Just for a quick guidance on how this session will run. Good afternoon, everyone. We have put on the in the chat box the way the session will run. During the course of the session, the facilitator and the organizers would, of course, commence at the appropriate time. And this is how we would engage the audience. You would be allowed to drop your questions in the chat space. So during the course of the session, there may be no room for interruption so that the session can flow seamlessly. So you could just drop your questions in the chat, group chat. Or also upon seeing that, if the facilitator deems it necessary at that time to attend to that question, it will be attended to. But with all assurance, the questions will be attended to before the session runs out. You could also use the raise your hand icon if you would like to say something, because as soon as the session starts, we would take away the right for everyone to unmute themselves. We would lock that right so that the sessions can go seamlessly. Now, the reason we will do that is not to restrict access, but to also prevent people who may unmute themselves without even realizing it, so that we do not get into private conversations that may be going on at the background, and of course, have it disturb the session. Please feel free to engage as freely as you want to engage, and let us know whatever challenges or questions you may have in the chat room so that we can quickly attend to it. For some questions or for some interactions, we may talk to you privately, and for some, we may have to engage publicly so that everybody knows what is happening at that particular point in time. My name is Charles. I will be admitting on behalf of the program partners, and I will be on standby to get any questions that you may have at any point in time. Thank you for your time. Thank you for your patience. The session will commence shortly. God bless you all.
Good afternoon, everyone. Lana Silks and ladies and gentlemen. The section will start at 2:05, just to give some room for those that will be joining us a bit late. So we'll commence at exactly 5 minutes after 2. Thank you for your patience. Good afternoon, ladies and gentlemen. I'd like to welcome you this afternoon to the training program, the seminar on the tax revolution, legal insights for a changing Nigeria. This is a program put together. They are an accredited professional training company, and they've been doing a lot of training, especially in the professional world, the legal and financial world. And you are please advised to always join their training programs. Will be the better for it. And of course, we'll be able to obtain our CPD points because they are accredited by the NBA. So during the course of this training, you might find the MBA ICLE registration portal popping up for you so that you can fill your forms and then you might be able to get your CPD points. I'm your moderator this afternoon. My name is Fred Ladapo. I'm a legal practitioner. I'm also the Honorable Chairman and Honorable Commissioner of the Tax Appeals Tribunal, Lagos Zone, Panel 3. I'm also a member of the Presidential Tax and Fiscal Policy Reform Committee. So I'd like to welcome you this afternoon. We have two speakers for this, experienced speakers, and I'm sure they will do justice to the topic we have this afternoon. The first speaker will be Professor Abiola Sonny SAN. I'm sure some of us know him. He's been able to catch a niche in the tax systems, tax laws, and consultancy. Professor Sonny is currently the Dean of the Faculty of Law of the University of Lagos and was admitted into the inner bar as a Senior Advocate of Nigeria in 2021. He obtained his bachelor's and master's of law degrees from Obafemi Awolowo University, OAU, University of Ife, that's Ile-Ife, in 1989 and 1992, respectively. In 1991, he began his teaching career in Obafemi Awolowo University as a junior trainee fellow. He rose through the ranks to the position of lecturer 1 and served as an acting head of Department of Business Law in 1997. He earned a strong reputation in the legal service community. In search of specialization and career advancement, he transferred his service to University of Lagos University, UNILAG, in 1999, and his career flourished therein. In 2003, he won the prestigious Fulbright Fellowship for Foreign Scholars, a 10-month fellowship at the International Tax Program of Beasley School of Law, Temple University, that's in Philadelphia, USA. He was also appointed the Research Fellow of the Institute of International Law and Policy of the same university during the same period. In 2016, he had the singular honor of being simultaneously appointed as a professor of commercial law and occupier of a professional chair endowed by Lagos State University of Lagos for the advancement of taxation and fiscal matters. This earned him the sobriquet of a double professor, perhaps the first in UNILAG, especially in recent times. So we have a double Professor Sonny here with us. He's a thoroughbred professional in a robust multidisciplinary background. He's a fellow of the Chartered Institute of Taxation of Nigeria, and he has served the CITN in different capacities as a Dean, Faculty of the Indirect Tax, and a member of the Taxation Standard Board. He is also a fellow of the Nigerian Institute of Chartered Administrators and a life member of the Nigerian Society of International Law. Since 2019, he has been involved in international arbitration under the International Chamber of Commerce, ICC, and the United Nations Commission on International Trade Law, trade law rules, as well as domestic arbitration. He is the author of Introduction to Nigeria Business Law, the founder and publisher of the Nigerian Revenue Law Reports and African Tax Law Reports, the first law reports devoted to tax cases in Nigeria and Africa, respectively. He has served the federal government of Nigeria in different capacities as a professional. He is a member of the Tax Advisory Committee, TAC, that service, and he served as the chairman of National Tax Policy Review Committee in 2016. Contrary to the infamous tradition where reports of committees are softly discarded, he was appointed the chairman of Nigerian Tax Policy Implementation Committee in 2017 to implement the key recommendations of the revised National Tax Policy. He has been a member of the Federal Government Fiscal Report Committee and Tax Advisory Committee, which is responsible for incubating Annual Finance Act since 2019. He served as a member of the advisory group of the International Center for Tax and Development for 2020. SAN is an advocate for sound corporate governance. He is the chairman of the board of directors of Tax Technologies Limited, Tax Aid Limited, Mouse Drivers Recruitment, Boarding Mothers Club, and a trustee of the United States Government Exchange Alumni Association of Nigeria, the umbrella body for beneficiaries of all exchange programs sponsored by United States government in Nigeria. He is a trustee of the Nigerian Law School alumni class of 1989 to 1990. He demonstrated exemplary vision and leadership during the early years in his career by coordinating a crop of 6 dynamic young lecturers to publish in 1998 the first book on legal methods in Nigeria, titled Introduction to Nigerian Legal Methods. The book has remained the leading introductory legal text in Nigerian universities and the West African sub-region. Professor Sonny maintains work-life balance through sporting and social interactions. He is a member of Octagon 90, FS Club, House of Commons, Science Boys, Ife Recreation Club, Ikoyi Club 1938, and Unilag Staff Club. Before Professor Sonny SCN comes up, I'll just let us understand that the new tax reform laws, some of which have commenced, and the major one which affects most of us, will commence on the 1st of January 2026. It has brought a revolution to the tax system and operations and administration in Nigeria. So how does it affect us? Professor Sonny SCN would be taking us on how it affects us locally, while our second speaker, Lolade Ososami, who is a partner at Udoma and Bello Osage, I'll be introducing her after we are done with the first speaker. She will be taking us on how it affects the international community that are investing in Nigeria, that are doing business in Nigeria. So we are covered on both the domestic and international areas wherein we are affected by the new tax law and how we are to respond to the law. So as tax administrators and practitioners and lawyers would be ahead of every other person after this seminar. So we'll start. This is how we're going to go about it. Professor Sonny SCN will present for about 20 to 25 minutes. After that, Lolade Ososami will also present. Then After that, we can then have the questions and answers that you will post on the chat platform, so that they can respond to questions that relate to their paper. So I want you to sit down, relax, be attentive, don't be distracted, so that you have the full benefit of this training. Thank you very much. Therefore, I would like you to welcome with me Professor Sonny SCN to take the floor.
Yeah, thank you very much, my learned friend, Fred Ladapo. Good to see you again. Let me appreciate Femi Oyedipe of Glimpses Limited for the kind invitation. It's also an honor for me to square up with my dear friend Lolade once again to deliver value to our association. I note that she'll be speaking on the international dimension, which is the juiciest part of tax administration. So you can see who is doing all the theory and then who is doing all the money making between the two of us. I see a couple of my friends, senior advocates on the platform. There's no time to acknowledge everyone. Let me just say hello to Wole Agunbiade, Senior Advocate of Nigeria, and also Seun Abimbola, Senior Advocate of Nigeria. So I give due regards to all the participants and all the excellencies that may be on the platform. So without much ado, this is the overview of my presentation. I'm just going to speak to it because there is very little we can do in 20 minutes. I just hope that 20 minutes will just start to count now. I'm going to look at the introduction, then I'll look at the pre-reform era, the major changes under the Act, then what are the major findings. Then from that, you'll be able to draw a conclusion whether this is a revolution or a quantum leap or something less or more. Then what are the salient legal issues? I'll just highlight that, then I'll conclude. We are all aware of the 4 acts signed by the president. I refer to this as a watershed in the annals of the Nigeria's developmental journey. And I said, well, whether it's a revolution or not, I will leave you to be the judge. I will only share the findings and also some salient points. Then you will be the judge of how to describe it. Before the reform, this is here where we are. The last one was almost 25 years ago. So we had some structural problems. Then we were not able to generate sufficient money because the states, which enjoyed a measure of fiscal power, were not able to actually optimize it. And look at the situation in South Africa. If you look at South Africa with a smaller economy and population, they were able to generate ×5 of what we were generating from our personal income tax. You can go through this slide later. So this led to the establishment of Taiwo Oyedele Committee, of which I'm privileged to be a member. And let me pause here to make some disclaimer. I am not speaking for that committee. I will be speaking as a scholar and as a professor at this time. So I may be a bit critical, but it only suggests that no work can be perfect, especially if the committee didn't have all the time it needed, and also if the committee wasn't in control of all the legislative processes that resulted into this. So these are the 4 tax bills. Now, what are the major changes under the Act? So the first one is Nigerian Tax Act. The Act repealed 12 acts, which I highlighted here. So those acts no longer form part of the corpus of the fiscal ecosystem of Nigeria. It also amended a couple of acts, it affected all this, and I've stated how they were impacted. Then about 14 acts were amended, which I've also listed. Then it revoked and amended some subsidiary laws. And it's important for me to stress this in the midst of lawyers so that we will recognize that apart from the statutes, there are also subsidiary laws made on different subjects, without which the statute cannot even be implemented. So I will encourage you to recognize the utility of this source of tax law and also leverage it in whenever you are working on any tax issue. So these are the subsidiary laws revoked. And then there is a saving provision in Section 199 that says that, look, all the acts, all the regulations made in the past will still be in force unless and until they are expressly repealed or amended. Then let me point attention to Section 201, which is like the supremacy provision. And it seeks to ensure that laws do not come up in future that will dilute or override the provisions of the various acts. So the issue that some of us as lawyers had was, is this not a kind of constitutional flavor? But the National Assembly have found a creative way to address it by saying that this provision is subject to the Constitution of the Federal Republic of Nigeria. And then the implication is that there will not be any non-tax law containing tax provisions that will now trump the provisions of these various statutes. So anytime we are talking about various statutes, these are specific statutes that are most relevant and will override any other law. So now, so right now we have personal income tax, companies income tax, petroleum profit tax, capital gain tax, warehoused under the Nigerian Tax Act. So these are the taxes that we have in Nigeria effectively. We have income tax, development levy, stamp duty, value-added tax, and surcharge on petrol. So let me go over that again. These are the taxes we have in Nigeria now. Income tax. So there is neutrality about income, irrespective of the source. So one statute imposing tax on all types of income from various sources. Then after that, we have development levy, which is a supplementary tax to income tax. Ordinarily, if the reform had worked out the way the committee envisaged, we would not have anything like this, because this is really an aberration. Okay, but it has to be tolerated because the provisions are products of compromises. Then stamp duties, value-added tax, and surcharge. Surcharge is also a supplementary tax, but I will talk to that a bit more critical at the relevant time or during question and answer. So let's now look at the portrait of the Nigerian Tax Act. It has 203 sections divided into 9 chapters with 14 schedules. And I want you to please pay attention to those schedules, because that is where the technical aspect of taxation can be found. You understand the utility of schedules in a statute. In order not to clog the substantive provision or the main body with certain details, which may be clumsy or didactic, so they just batch it to the end. So don't ever think you understand the tax law without understanding the provisions of those statutes. So these are the highlights of the Nigerian Tax Act. Let's look at it. Taxation of income, I spoke about that. Taxation of income from petroleum, relief for double taxation, taxation of dutiable instrument, that's stamp duty, value-added tax, the surcharge that I spoke about, then incentives. Then we have the various schedules that I spoke about. So what I did here, time will not permit me to dive into them, but let us be honest. I don't think there is anyone here who has not had the benefit of a review of the general provisions of the tax statute. So I can take it for granted that to a large extent, I'm talking to an enlightened audience. For God's sake, this is an audience of lawyers. So now there's a threshold of 800,000. It was a big fight. The state thought this was a giveaway, but Taiwo in particular stood his ground. He would have even wanted this to go up. And then there is a new rent relief. And this is the new income tax bracket. So before you are subject to this first 7%, you would have had the benefit of the first 800,000 of your money tax exempt. So when people say, oh, it has done away with consolidated tax relief, consolidated tax relief is not as big as this, except for the very big boys, except for the big boys or the fat cats. So these are the introduction, these are the changes to companies' income tax. Better deals for companies with a turnover of below 50 million, no tax. Then deductibles, now more liberal, now more business friendly. Instead of 4 tests, we now have 2. Then there are also incentives geared to encourage investment. The lottery and gaming now have specific provisions in the Nigerian Tax Act. Then capital gain tax, also there is a threshold. Okay, now CGT, after the threshold, will be liable to 25%. Now, the development levy of 4% on the assessable profit of companies, except companies that are subject to PPT or hydrocarbon tax. And also small companies are foreign companies. So the proceeds of development levy will now be shared amongst various agencies, including TED Fund, NIDA, and also NASENI, Infrastructure Fund, and a host of others. This was a compromise. The committee wanted the special taxes to go, but the agencies fought back. The committee even wanted a sunset provision after about 3 years, but they fought back. And these are very powerful agencies with deep pockets. Now, VAT is now going to look like the re-VAT. Because re-VAT will accommodate input, deduction of all input VAT. For example, if you have a law firm, you pay VAT on your consumables and also on your stationaries, even your capital. You can now deduct them from the tax collected. The input VAT is what distinguishes VAT from other consumption taxes. And if you don't have input VAT deductible, what you have is a pseudo VAT, not really. Then we are familiar with this new distribution formula, which sparked controversy then. So let me quickly jump to stamp duties. Now we have only 12 specific instruments that are chargeable, unlike before when the schedule containing dutiable instruments is bigger than any tax textbook. So stamp duty now also has a threshold. The 1939 law was finally amended. Then we now have this surcharge. Even before I talk, I want to hear the comment of the participants. Now there's a 5% retail price of fossil fuel, and I'm quoting it, fossil fuel products provided or produced in Nigeria, and it's at the retail price. That means for every PMS you buy, you pay a 5% tax. I didn't know when this crept in. And I would like to have Fred's opinion until I was paying close attention to the law. This was never discussed. It was never debated. And then it's a big embarrassment to some of us who are in the, look at the exception, clean and renewable energy products, also kerosene, cooking gas, compressed, Now, Nigerian Tax Administration Act, it has 148 section 5 schedules, and these are the provisions. So what I've done is to curate all the important provisions of the NTAA. And you will see them. They are basically all the provisions in the various tax law on administrations that were initially overlapping or inconsistent were brought into NTAA and streamlined. For example, whether it is personal income tax, CGT, stamp duty, the penalty for late payment is the same, rather than having provisions for filing in different laws. So let me just quickly skip through all this. So these are the provisions of the Administration Act. For example, there are provisions for about 12 returns, focusing different agencies. Agencies that in the past, maybe the FRS was not even mindful of some of this. Then the interest and penalties have been revised, and there is also an attempt to penalize an infraction of the law for which no specific penalty was prescribed. So there's a specific provision to leverage technology, because in the past, companies have fought back to say that the tax authority cannot plug into their system on privacy grounds. And then there have been judicial pronouncement on some of this and all that. So there's a provision for advanced tax ruling and all that. So I've kind of summarized all this. Then there's a provision for the establishment of states and local government revenue authorities. Then there is administrative penalties. I'm going to talk briefly about that. And by administrative penalties, we meant the tax authority on their own will be able to say, you are liable, go and pay. I know any lawyer, and every lawyer will find that repulsive. And I will comment a bit about it, quite elaborate, vesting them with power too. Then, general offenses, this is the one I'm talking about. If no specific penalty is imposed and there is an infraction, you pay 1 million. Then FRS again has prosecutorial power. This is not particularly new. What is new there is that the fiat of the Attorney General has been downplayed. I've spoken about supremacy clause before. So what are the changes on Nigerian Revenue Act? Nothing much. It's just rebranded the FRS, call it a new name, and also try to empower it and strengthen the composition. So now it's not just going to be the chairman. There will be 6 executive directors. 6 executive directors who will be in the board, and they will come from the 6 geopolitical zones. So FRS is going to get more money, 4% of the total non-oil revenue, which is now larger than before. I need to really rush so that I don't want to overshoot my time, but I can come back to any of this if there is any question or interrogation about any of the issues. So what are the findings? Previous tax provisions have mainly amended the existing laws, abolished some taxes, and introduced new taxes in 1993, education tax, and also PITA. So the current reform goes further than that by seeking to Nigeria is going to make more money even by exempting more people, because focus will now be on the people at the top and also the big company. Because over 90% of the company's income tax are paid by less than 2% of the companies. So FRS wants to focus more on the big tickets. Now promote equity. In the past, the focus is on those in the informal sector and also those who are in employment. So I attempt to broaden the tax base now. I can explain that better during question and answer time. Also strengthen and empower the FRS, create new institutions and empower the existing one, enable businesses. We've never had any tax reform that is this business friendly. Curb evasion, address the challenges of multiplicity of taxes, then also repeal some laws. Let me now go to the salient tax issues. I have about 5 minutes more. Am I correct, Fred? How many more minutes?
Yes, you have 5 minutes, but you can take
Okay.
up to 10. Yes.
Oh, thank you so much. Let me
Yes.
set my alarm to read 10. Just a minute, please. In my university, you are respectful of people's time. And as civilized people, I don't want to overshoot my time. Okay. So now, what are the salient legal issues? Thank you for that indulgence. This is really important. Then the first one is limits of federal tax reform. Even if we say this is by Nigeria, we have seen the reaction of the state governor and also NEC, National Economic Council. So most of this reform will not percolate, and then an average person on the streets may not really feel it directly. So if we want a reform that will get to people where they live, where they work, we need to be talking about state tax reform. And my expectation is that Joint Revenue Board, under the leadership of my able and amiable friend, Segun Adesokan, will lead by providing templates for some states to borrow. Then issues of fiscal federalism. We have seen this play out during the debate on whether the bill should be recalled or whether the bill should proceed. So while cooperative federalism is commendable here, I'm an advocate of cooperative fiscal federalism, because under the Tax Administration Act, a state can ask the federal to collect tax on his behalf. And why not? That's what we have in Canada. But yet, a state that wants to do it alone should also have that prerogative. The province of Quebec will always, for reasons of federalism, want to do it by itself, even if it is not as efficient as the center collecting it for it. So the next one is imperative of constitutional amendments. There are cases in court now. There's one at the Court of Appeal on VAT. There's a case of the FRS and Ukala, where Ukala, senior advocate of Nigeria, was vindicated that, look, VAT is not a federal matter, but in any case, the federal government had appealed and the matter is still before the court. What we are taught was that matters relating to constitutional amendment issues relating to taxation will be expedited. But now it has entered the same loop with every other constitutional amendment proposal. So the people that want more states will not even let the voices relating to this subject be heard. I didn't hear any comment on this throughout the entire conversation. The legality of administrative penalties under Section 98. There are clear judicial decisions that only a court of law can penalize after judicial process. Okay? So all the administrative penalties that were brazenly inserted in the law may actually, they may be successfully challenged by astute lawyers, but time will tell. The legality of the omnibus provision, the provision that says if a taxpayer offends any of the provision for which no specific penalty is provided, then the taxpayer will pay 1 million. So there could be argument for or argument against, but my own school leans against that type of legislation for lack of clarity and also for lack of prescription of what the penalty will be. Because we already have sufficient penalties and offenses. If we need to create new ones, why not in future? You know, you cannot make one law that will address all the possible issues that may emerge within the ecosystem. Then interrogation, the political economy of the surcharge of 5%. Some people say, oh, they found a way to bring back excise duty that the National Assembly rejected, or they found a way to now bring back the increment of VAT that everybody rejected, you know? So, and I'm calling on the president not to authorize the implementation of this provision. I'm going to do a further follow-up on it to sensitize people to it. So now, this is my conclusion. Let me read it. The recent enactment of 4 major federal tax laws represent a watershed moment in Nigerian fiscal history. This legislative instrument collectively embody an unprecedented tax reform initiative, arguably the most ambitious, audacious, and business-friendly till date. However, notable expectations such as the controversial surcharge on petroleum have generated significant concern, potentially undermining the overall pro-business orientations of the reform because it's going to affect everybody, including the poor that you are seeking to protect. So while the reform will undoubtedly lead to a significant revenue, if well implemented, the question is whether it will also bring about accountability. I know a lot of you will ask questions about accountability, and let me tell you right away, if you are angry with the way money is being spent, go and contest. The way lawyers tell people, go to court. That would be because if you are not in control of the management of the fund, you can really say very little. The CSO, the NGOs are already beaming focus on how we are spending, but it appears as if this is actually not addressing the conscience or the issues at all, especially at the subnational level. So critically, the imperative of targeted tax education cannot be overstated. Legal practitioners must be equipped with a deep understanding of the new law before full implementation begins. Such capacity building is essential not only to ensure compliance and avoid professional pitfalls, but also to contribute constructively to the evolution of the Nigerian tax jurisprudence in the post-reform era. Ultimately, while the reform signals progress, its success will depend on rigorous legal scrutiny. Some of them will be tested in court, stakeholders' engagement, and sustained investment in tax education, and also institutional capacity. We cannot discuss this subject in 2 hours, let alone 20 minutes. So you must take responsibility to look at the laws yourself, understand it clause by clause, and also raise critical issues so that you can also join voices with those who have some measure of expertise on the subject. So this brings me to the initial question. Will the tax reform trigger a fiscal revolution? So I end with the story of a young boy who went to a wise sage who lives on the hill and asked him whether the little bird in their hand was dead or alive. The prediction of the sage had never been wrong before this time. So assuming that you are the sage, what will your answer be? The answer is, it is in your hands. So it depends on how you see it. So distinguished ladies and gentlemen, astute moderator, thank you for the indulgence of an extra minute. So this is my presentation. I'll be happy to take questions after. Thank you very much.
Thank you very much, Professor Abiola Sani. Nice to see you once again, and to see you dealing with these issues. Really thank you, and thank you for that wonderful paper. I know it contains a lot and detail, and I've even heard someone saying that we should kindly make available the webinar papers delivered for participants for the research work. So we hope that will be done. We thank you. This is a good dissection of the Tax Act. I want to recognize some everyone. Learned folks and judges in our midst, we welcome you. And particularly, I want to recognize 2 members of the MBA Institute of Continuing Legal Education, who are members of the board, who are here this afternoon. Professor Lanre Adeboale Alade, we welcome you. And Agabiadu Chukwumeka G. Didiani Esquire. I hope I pronounced those names well. If I've not, please forgive me. You are welcome very much to this training for making this possible, and for the CPD points that we are getting this afternoon. I want to thank you. So you're all welcome. We'll go. Please keep your questions coming. Those questions will be answered after the presentation by our second speaker. I would like to introduce her to us before she goes ahead to present her paper. She is Lolade Ososami. She's a partner at Udo Udoma and Bello Osage, and heads the firm's taxation, compliance, and mining metals team. Lolade is an expert in the legal and regulatory framework for international investment in Nigeria and advises on diverse domestic and cross-border sectors. She is renowned for her advice on tax aspects of diverse commercial transactions, including transfer pricing, exchange of information, reporting obligations, and tax regimes applicable to the extractive industry and renewable energy projects, including biofuels. Loladi's expertise contributes to the success of the firm's tax controversy practice, which has successfully obtained a landmark ruling relating to the tax appeals process in Nigeria. Our standing in the tax field is reflected in our Band 1 ranking and partners, the leading legal directory. Loladi is a fellow of the Chartered Institute of Taxation of Nigeria and has served as the chairman of the taxation committee within the section on business law of the Nigerian Bar Association. She is also a member of the tax committee of the International Bar Association and a member of the International Fiscal Association. So you could see from this that there is no better person this afternoon to present this aspect of the law that affects the international community. Before she comes on to take over the stage, I also want to welcome Mrs. Sarah Ajijola, who is a director with the ICLE on the training. She's also a director, so three of directors of MBA, Institute of Continuing Legal Education, and the competence and the confidence they have in glimpses in training lawyers on the act and on the new issues in the legal profession. So I want to ask you to keep tabs on glimpses. They would give further training that would improve our competence as lawyers. So please, let's keep a tab on them and join their training sessions. So I'll leave the floor now for. You are most welcome to tonight, to this afternoon session.
Thank you very much. And thank you for the opportunity to present this afternoon. I'm sorry, I'm struggling with my slide sharing. I don't even know whether you can see my slides or not. Dear moderator, could you please confirm whether you can see my slides yet?
No, not yet. We can see you, however.
Okay.
Yes.
Let me, please pardon me. Let me attempt to share once again. How about now? Can
Absolutely,
you see my
yes, we
slides?
can now. We can now. If you could put it on the slideshow.
Slideshow, correct. Okay, 1 second. Okay, are we good to go?
Yes, we can see the first slide, the chairs, and the tax
Okay.
resolution. Thank you
All
very much.
right. Thank you very much. Thank you. A huge thank you to Glimpses and the leadership of the continuing learning education of the NBA. I feel honored to contribute to the development of our noble profession. So I was quite intrigued by this topic, the tax revolution, legal insights for a changing Nigeria. And like my dear friend, brother, and colleague who I dearly call the Silky Prof has well the revolution. I'll be looking at this from an international dimension today. And my posit is that indeed there is a revolution, but it's a revolution that is bigger than us. It's a revolution that has started a while before now. So this is the outline of my presentation today. We'll be looking at the definition and principles of international tax law. But I think that it is important to lay a foundation anytime we talk about tax from an international dimension, because international tax law, I find, tends to mean different things to different people. So hopefully this afternoon, I'll be able to convey in very simple terms what international tax law is really about And that would help with that context. It will set the stage for us in analyzing how this affects implementation. So we're going to look at the revolution, and then we're going to talk about the impact on Nigeria's tax landscape. So going straight into the introduction, international tax law, I have chosen to define this afternoon as a body of legal rules and principles that govern how income, profits, and assets are taxed when they cross national borders. And this definition really is the basis for what is at the core of international tax, and that is simply the sharing of taxing rights between nations is determined by two fundamental principles. And an understanding of this is so critical in how we approach our advice when we advise on cross-border transactions, how we adjudicate when we have the privilege to adjudicate on tax matters. So there are two fundamental principles that govern the sharing of residence principle and the source principle. At any point in time, either of these two principles form the basis of the liability of a company or a person to tax when it comes to cross-border transactions. And so what is the residence principle? It is that principle that says a country can tax its residents on their worldwide income. And that is a standard application of Nigerian, you're a resident in Nigeria, you are taxed on your worldwide income. In other words, whether you earn that income in or outside Nigeria, as long as you're resident in the country, you will be taxed on your worldwide income. And that's how it is across jurisdictions, except where specific jurisdictions, for certain reasons, introduce an exemption or choose to have a zero. And most of the jurisdictions that fall within that category are jurisdictions that typically are described as tax havens. So you can understand why they're called havens, because anybody who is resident in those jurisdictions can live there tax-free. And there are nations that this is how they actually make their money. They attract, because they don't have natural resources, because they are tiny, a lot of them are tiny islands showered all over the Atlantic, and people to their countries by offering zero tax to residents. And of course, they know that when you come, you will spend money on other things. So you spend money, for instance, on consumption. You probably spend money on acquiring property and so on. So they find other ways of making money, but they use a zero tax rate to attract traffic to their jurisdictions. So except for those type of places, in other jurisdictions, once you're resident, you're taxed on your worldwide income. It says a country should tax income generated within its borders, okay, regardless of the recipient's residence. So there are two things here. You're either being taxed because the source of your profit originates from a particular jurisdiction, or you're being taxed because you're a resident in that jurisdiction. So we'll see how this plays out. There are objectives that international tax law goes into three basic objectives. The first, of course, is the avoidance of double taxation. In other words, you shouldn't punish a company that chooses to expand its business across borders. And you shouldn't punish an individual, for instance, maybe a professional or a sportsman or what have you, who is able to use their talent to earn income from diverse jurisdictions. In other words, when a person or that person could be a company or an individual. When you earn money, yes, you're supposed to pay tax, but then you're not supposed to be punished just because you're operating in two countries as opposed to your neighbor who is operating in one country. So there's that avoidance of double taxation as an underlying principle when it comes to international tax. Then you have the allocation of taxing rights. Like I said, that is at the core of international tax. Who then should be entitled to tax the income from this company that operates within 5 countries across 3 continents? Whose right is it to tax that income? If you're saying that you don't want that company to pay tax all over the place, because ultimately that means you're punishing them for being global in their outlook, who then has the right to tax their income? Right? The third principle also is then to prevent tax evasion and avoidance. And these things fall, into one another. So to avoid double taxation, okay, you have to have rules to allocate taxing rights. And don't forget, I'd already mentioned the 2 fundamental principles, which are the residence principle and the source principle. Now, around these 2 principles, and those rules are the rules that then determine who has the right to tax. Now, on the other side, you have companies, huge companies, largely multinationals, that fall into this category of cross-border earners of income. And over the years, of course, their tax departments and finance departments are usually tasked with the duty to ensure that the organization is not sufficient, that the organization is managing its tax affairs in an optimal fashion. Over time, that has led to tax avoidance. Tax avoidance, legally speaking, is not a crime and it is not wrong. To avoid being overtaxed is not a crime and is not wrong. However, when that avoidance gets to a level that begins to translate to evasion, that line over the years became so thin that some countries started to feel that this has gone beyond avoidance and is now looking like a shade of evasion. And so that triggered a revolution, okay? That revolution was exacerbated also by the evolution of how we do business. So over time, you had a development of multinationals increasingly, and when you look at it, being a multinational is actually not a bad thing. It's fantastic. Multinational institutions or organizations are the vehicles by which technology is transferred, employment is created, wealth is created. Integration, global integration is encouraged. So being a multinational is not a bad thing. However, like I said, you also had an evolution of business models. Business models moving now away from brick and mortar into digitalization. So the combination of ballooning multinationals, evolving business models into digital business models that enabled companies to be able to earn income across jurisdictions without a physical presence, plus aggressive tax avoidance, led to a global tax revolution, which was actually pioneered by a group called the G20. The G20 is a a group of 19 countries plus the EU, making them 20. And recently, the African Union has also joined the G20. So maybe they should change their name to G21. But essentially, the G20 then commissioned the OECD to assist in tackling the challenges that arose from the combination of those three factors that I just mentioned. Maybe I should move on to the next slide. So the OECD, the Organization for Economic Cooperation and Development, and the United Nations, which both play important but distinct roles in shaping and guiding international tax policy, were now saddled with the responsibility of addressing these challenges. So on this slide, I'll be talking about international tax institutions and their roles. Okay, we've defined international tax law. We've talked about the objectives. Who are the people driving these objectives? They are international tax institutions. The two major ones are the OECD and the United Nations. But you also have the World Bank and the IMF and other regional bodies that contribute to the development of international tax. So moving on, how do these organizations regulate, manage, administer, whatever you want to call it, this international tax system? They do that by deploying what I've called international tax instruments. And these instruments are made up of tax treaties, which could be bilateral or multilateral. But these are international conventions, agreements between countries who come together to say, okay, we're going to agree that our citizens and your citizens, whenever there's any cross-border interaction between our two countries, parties can be guaranteed that they will not suffer double taxation. Then you have transfer pricing rules. Transfer pricing is something that has also evolved from the way multinational groups operate. So, you know, when you talk about single unit entities, assuming I'm a manufacturing company and I manufacture butter, okay? Or let's say I manufacture fabrics. I'm a textile manufacturing company and I'm company A. Company B has no relation with me that processes cotton plants, okay? And then company C is a company that provides agro-technology services, right? So these are three single companies, everybody going on with their own business. In the multinational group setting, these three functions can sit within the same group. So you have one company, instead of company A transacting with company B to buy processed cotton, and then company B transacting with company C to buy agro-allied services. You have company A setting up an agro-allied unit, setting up a cotton planting and refinery processing unit. And that's one organization. Now, the issue is this, because the three of them now sit within a group, the cost is not at length. It's because everything is coming to one port. Company A, or that, yes, company A can afford to offer its service to a price, and company C can afford to offer its services at a reduced price. So just, you know, at the very basic level, that's what transfer pricing, that's how transfer pricing developed. In other words, if you compare the multinational group system with the single unit group system, you find that there can be an imbalance, because within the group, the issue of adding a profit element, for instance, to the cost of goods and services, can be done away with. which effectively maximizes the profit margin of the group. You don't have that with a single unit entity, because as he's engaging the services of Company A has put its own profit margin, and as it's engaging the services of Company C has put its own profit margin. And so that brings us to the principle, the arm's length principle. So all of that is at the heart of transfer pricing. And transfer pricing is also an issue when it comes to international tax, because of those balances and imbalances that I just described at a very basic level. And so the need then arises to also regulate transfer pricing through the use of instruments. So you have transfer pricing regulations, for instance, in Nigeria. In some jurisdictions, they go beyond regulations. They actually have transfer pricing legislation. Then you have exchange of information agreements, which enable jurisdictions, tax authorities within jurisdictions to share information. And then finally, of course, you have domestic tax laws, because without domestic tax laws, you cannot implement international tax laws or principles. So these are the instruments by which international tax law is implemented. Now let's go straight into the revolution. So as I discussed, this revolution started with the G20 engaging the OECD. And in 2013, the OECD came up with the BEPS initiative. And I'm sure many of us in the audience are by now familiar with the BEPS initiative, because Nigeria has prominently featured in that space. But BEPS stands for base erosion and profit shifting. In other words, the erosion of tax bases and the maximization, as it were, of profits by shifting profits from one place to the other. So the OECD launched the BEPS initiative, in other words, which is to identify how tax bases have been eroded over time. Pardon me, please, there's some little construction work going on around me. And they came up with proposals to tackle this base erosion and profit shifting, which ultimately was leading to less and less tax revenue for countries. For some countries, in 2015, the OECD published a 15-point BEPS action plan, and in 2016, they established the OECD Inclusive Framework. Now, prior to 2016, the OECD was largely made up of European countries, or let me say countries in the developed world. A lot of the countries in the developing world were not members of the OECD, and the OECD was largely European in constitution. But as this BEPS issue was analyzed and the proposals that were put forward to tackle the challenges, it became obvious that the global north was going to really need the help of the global south. The developed jurisdictions were going to need the help of the developing jurisdictions. Why? Because at the center of this revolution, the problem that led to this revolution is digitalization. So what did you have? What you had were companies like Google, Amazon, the tech giants, right, rising up and accessing markets all across the globe and making money from those markets without paying taxes in those markets, because they didn't have brick and mortar there, but they had access to those markets. And of course, the developing world is where you have the larger share of consumers. Africa is a huge consumer of goods and services. Nigeria within Africa, for instance, is a large consumer of goods and services, international goods and services. Why? Because of our population. While the global north have dwindling population. In developing countries, you have population explosion. And the more the population explodes, the larger and the bigger the market for anybody who offers goods and services. And so developing countries are attractive markets for tech giants or any provider of goods and services for that matter. So in order for the OECD to tackle this problem, they needed the cooperation of the developing countries. First of all, by letting developing countries even become aware of this challenge, by letting developing countries become aware of the potential revenue, tax revenue that they could make from the activities of the tech giants. And so they established the OECD Inclusive Framework, which essentially opened the door of the OECD to developing countries. And so Nigeria became a member of the Inclusive Framework on the 30th of June, 2016. So moving on to the BEPS action plan, let me quickly talk about that in summary. The BEPS action plan, right, had challenges. The OECD, with the inclusive framework now, had the task of tackling the tax challenges, rather, of the digitalization of the economy by changing the rules that govern the determination of a taxable presence. Please pardon me. Remember, I told you about the two fundamental principles that govern international tax law, which is the residence principle and the source principle, right? And these are the principles from which the rules are that govern who has the right to tax, right, derive. And so when we talk about digitalization now, where there's really no physical presence per se, in fact, you don't even need an employee. Amazon does not need any of its employees, for instance, to be in Nigeria, to operate to access the Nigerian market. Let me put it that way. They don't operate, they access markets. So to access markets, really, all you need is a digital platform and the internet, okay? And so somebody in Nnewi with an Android phone connected to the MTN network can get data and can purchase from Alibaba, from Amazon, and so on and so forth. This was what was going on. So when you come to the rules that had developed over time to determine taxing rights, those rules were developed with the idea of brick and mortar, right? In other words, if you were a foreign company and you wanted to do business in, let's say, Africa, Nigeria in Africa, all right, you either had to be there physically, so you either had to have a fixed base there, or at least have an agent there, maybe an individual who does all your runs for you, but there had to be a physical nexus, all right? But with the digitalization, in the digitalization era, you didn't need that physical nexus. So now, to tackle this challenge, it meant that the international tax community have to rewrite the nexus rules. And that was the action 1 of the BEPS initiative. Secondly, their task was also to tackle aggressive tax avoidance, as I mentioned previously, tax avoidance schemes used by multinationals. How? By tightening anti-avoidance rules, right, such as transfer pricing. I mentioned transfer pricing already. And transfer pricing is one of the ways by which multinational groups also tend to reduce their tax exposure. And in the process of tax planning, remember, like I said, it started getting to alarming rates where it started looking more like evasion than avoidance. So the OECD was saddled with the responsibility of tackling that. Thirdly, they also needed to tackle the base erosion and profit shifting they had discovered by tightening the rules that apply to application of double tax treaties. And finally, to promote transparency through the automatic exchange of information. Because if country organization is behaving in country B, then the organization can play both jurisdictions. So to mitigate that, you then have collaboration between jurisdictions through the use of automatic exchange of information. Now, these things are very important because as we now begin to see certain provisions appearing in our domestic law, we can trace the origin of those provisions. And so for me, I always feel that it's very important to understand context from a holistic perspective. When you hold a tax legislation in your hand, before you interpret, understand where all of this is coming from. So let's talk about implementation of the BEPS initiative, which began in 2015. First of all the members of the OECD and the OECD Inclusive Framework, by signing multilateral agreements. Several of them were signed, but I'll mention the most prominent ones. The MLI. The MLI is the agreement that was signed to enable all the members of the OECD and Inclusive Framework to amend existing bilateral tax treaties. Now, when you have a bilateral tax treaty, if you want to amend the treaty, the two countries need to come together and begin discussions, negotiate, agree on the amendments, and then issue protocols to implement those amendments. That process usually takes time. It can take as much as 5 years sometimes, to arrive at those protocols. Because of the urgency of this matter, the MLI was signed as an agreement that enabled members and signatories to that agreement. First of all, members of the OECD Inclusive Framework, you have to be signatory also to the MLI, and who then have bilateral treaties between themselves, amend those treaties simply by selecting certain provisions within the MLI and coming together under a competent authority agreement to agree that, okay, we're going to amend our treaty with this clause, with that clause, with that clause, and the process of amendment is achieved with, in a short time.
Sorry, Lolade, you have only 3 minutes left. I know you
Oh
can
my
go on
God,
and
you
on.
should have warned me when I had 10 minutes. Okay.
I'm sorry.
All right, let me run then to the okay, I'm not too far behind. Okay, so I'll stop talking. No, let me go back to my slide so that for the purposes of education. Yeah, so you have those agreements. Yes, okay, I've talked about this. Now let's go to the impact of all of this on Nigeria's tax landscape, okay? Okay, I'll skip all of this. This is just telling us how things have gradually been integrated into our laws. So between 2017 and 2018, you had the FRS signed the MLI, multilateral agreements. You then saw the transfer pricing regulations amended. You also saw the country-by-country reporting regulations, which is an automatic exchange of information instrument, and then the common reporting standard regulations, which is the same thing, but limited to the financial sector. And then you also had from 2019 to 2023, the Finance Acts, right, that were enacted, and you would observe that with each Finance Act, certain changes were made, particularly, for instance, to the rules around VAT. And other introductions were made into our domestic laws as well. So with everything I've shared, you can now see where those changes came from, right? You had the interest deductibility rule that was introduced. You also had the guidelines on mutual agreement procedure that was issued. And then 2024, the tax reforms continued, but in 2024, The Presidential Committee on Fiscal Policy and Tax Reforms was then inaugurated, and 2025, the new tax laws emerged. So what are the changes introduced by the new tax laws that affect cross-border transactions? First and foremost, we now have a set of new domestic source rules. Domestic source rules are very important because when we talk about cross-border transactions, when you want to assess the applicability of tax laws to cross-border transactions, this is where we start. We start at with the domestic source rules. Where there is no bilateral tax treaty in place, the domestic source rules would be applied. So it's important for any lawyer that is advising on cross-border transactions to understand what those rules are. Those rules used to be in Section 13, subsection 2 of the CETA. They are now contained in Section 17 of the Nigerian Tax Act. Then we also have new anti-avoidance provisions that have been introduced in the Nigerian Tax Act. We now have a controlled foreign company regime, which we did not have before, and which most developing countries really don't have, because we have very few Nigerian companies that have subsidiaries in foreign companies. It's usually the converse, okay? But now we have CFC rules. So organizations like Dangote, for instance, you need to look at that very closely, EcoBank, and so on and so forth. Any organization that is a Nigerian company that has subsidiaries outside Nigeria need to look at CFC rules, understand what they are and how they apply. Then we have VAT regime now under the Nigerian Tax Act. We have the application of capital gains tax to indirect transfers. We have new treaty application rules with the introduction of unilateral relief. And then we have a 4% minimum tax for non-resident companies that do not have a taxable presence in Nigeria. And this is very important. In international tax law, we must understand that not every foreign company will have a taxable presence in our jurisdiction, right? Not every, so because like I said, don't forget that the underlying principle of international tax is also to prevent double taxation, okay? So that is important, especially for those in tax adjudication. The fact that a foreign company has dealings in Nigeria does not necessarily mean that. However, the introduction of this 4% minimum tax is somehow to sort of at least catch such companies where you can trace the source of their profits to Nigeria. Then you have the introduction of a 15% minimum tax for non-resident subsidiaries of Nigerian companies, which is an adaptation of Pillar 2, something I won't even bother going into here, but is part of the implementation of the OECD solution to the problem of digitalization. Because of time, I won't talk much about that because I want to complete my slides. Then you have resolution of international tax disputes, administrative methods. More of administrative methods have been introduced. I've listed where you can find those in the Nigerian Tax Administration Act. Of course, the tax appeal system still exists through the Tax Appeals Tribunal. Then you go to federal high courts and so on and so forth. Nigeria still has not adopted arbitration as a means of resolving tax disputes, but I believe we will get there. It's only a matter of time, okay? We recently had something on tax ADR, which was quite interesting. So I've pretty much finished my presentation, and here I have inserted a glossary of the acronyms that I have used in my presentation, which you can look at, you can refer to. I've also recommended some research tools for those of us who want to deepen our knowledge and make the best of the nuggets I have shared. And my closing remarks basically are that international tax practice in Nigeria, but I think that it is very important for us to deepen our knowledge of it, to understand the scope of it and how it's implemented, so that we do not also shoot ourselves in the foot by chasing away foreign direct investment through the wrong interpretation of the rules that govern international tax or misguided adjudication when we deal with disputes relating to cross-border transactions. Finally, I've inserted some information about myself on the last slide, and that brings us to the end of my presentation. Thank you very much for the opportunity. I welcome questions.
Thank you very much, Lolade, for that very insightful presentation, extremely loaded, and you can see why participants are asking for a copy of your presentation online, which I'm sure the organizers, Glimpses, will look into that. On the issue of the arbitration that you mentioned, I must say that the Tax Appeal Tribunal, of whom I'm a member, we encourage settlement. You know, that is why the tribunal is there. It's an administrative tribunal, and so settlement of cases and between parties are actually encouraged, and it's also time framed so that within 6 months we expect that most matters before the tribunal will be dealt with. So thank you very much. We go into the question and answer session. Before then, I must encourage us that the forms will soon be made available online. The CBD forms by the NBA ICLE. So once it pops up, I'll inform you so that you can fill the form, and then you can be allocated the points that the CBD points. So questions and answer. There are questions here. I have 7, 8, 9 questions. Most of them are directed at the local environment. And I hope Professor Sonny is still there. Professor Abiola Sonny, and most.
Yes, I'm here. Yeah.
Yes, and so Lolade can also give us our own insight into some of these questions if you feel that you'll be able to add more to it. The first question that I have here is, when will the new tax acts become operational, and when will the printed copies be available for purchase on bookshelves?
You want me to jump on that?
Yes, but I can easily answer
Okay,
that.
Okay, please do. Go ahead. Yeah.
I just let me just mention them one by one so that we may know. The Nigerian Revenue Service Establishment Act commences has already commenced 26th of June 2025. The Joint Revenue Board of Nigeria Establishment Act has also already commenced 26th of June 2025. The Nigerian Tax Administration Act 2025 has already commenced as well on the 26th of June 2025. But the Nigerian Tax Act, the real one that we've been expounding on, will commence on the 1st of January 2026. That is when the act will commence. So all these other laws are meant to put the institutions in place that would operate the new tax act. I think, Professor, do you want to say any other thing?
But Fred, is that not confusing? I mean, why are you going to have a set of 4 laws, and then 3 had commenced, quite against all logic and all, even the provisions of the national tax policy?
Yes, I guess.
And then you are even saying it commenced before people had the benefit of seeing it. I think it would have been better if the 4 statutes commence the same date in future. And I guess something like that is likely to be done. We have always modeled simple things up in the fiscal space. but I hope in future we'll learn from this and then put our house in order.
Yes.
About the
But-
physical copy, the gazetted copies, they are already out.
Okay.
And then I believe in the course of time, the physical copy will also come out. Yeah, thank you.
Thank you very much, Prof. I think their thinking was maybe to prepare the institutions before the time when the operating law would commence. But like you said, it's a bit tardy. It should
Let
have
me
commenced
give you one problematic issue.
Yes.
If the Nigerian Revenue Service establishment had kicked in, and I received an assessment in the name of the existing authority, an astute lawyer can pick that up and then spin it the way he wants.
Yeah.
Okay, so because what you are saying is that the existing one is already sunset, or it has transmuted to the new one under the new legal order. So it's an issue that I believe an executive order may likely come to clean up. It's not good. It's not good at all. Yeah.
Thank you very much, Prof. The second question is the one you asked yourself about the 5% surcharge on fuel that was introduced. I would say smuggled, was introduced into the act. The good thing is it's the law says that the Minister of Finance had to activate that clause, and I believe that that 5% should be activated when the purpose for which the fund will be used is identified. So it's already in the law, but I believe that it should be activated.
We mobilize against it. We will mobilize against it because it's anti-people. We made a promise not to increase taxes, and then the president said so. Taiwo said so, and this was never discussed. And then even the parliament voted against increment of VAT and also a new tax on a new excise duty on telecom. So how come at the last minute a surcharge of 5% that was never discussed, and then we promised to use plain language? So what's the meaning of fossil fuel? That's why some people didn't notice it.
Yeah.
I mean, you should call a spade and not a garden egg. I'm sure the civil society will rise up against this, and that is why I'm calling on the president not to implement that bit and send signals to them that it's not even good for the president. The poor that we are saying we want to protect, they are all going to receive the shortest end of the stick at the end of the day. So let's see how it pans out. I don't see how that is operable, honestly. I may be academic in my view. Yeah.
Yes, thank you very much. I think also there are many ways to go about it. He says it should be 5% on food that is produced in Nigeria. So the government could give some relief to the companies maybe producing petroleum in Nigeria, like Dangote, and give them a 5% reduction in the cost of crude oil. So that way, the benefit is nilled out, if I may put it that way.
The economy is not smiling. Things are very hard.
Yeah.
So this is not the time to put tax on fuel.
Yes.
I don't know who can come out to justify this.
I thought, okay. Anyway,
it's wrong-headed. It's headed in the wrong direction. I don't see how this can fly.
Yes.
With due respect, yes.
Yes. Anyway, like I said, the minister has to activate it, so it's not really in force yet until it's activated by the Minister of Finance. So the next question is, the PIA mandates environmental remediation and decommissioning funds. Are these funds subject to taxation, and how are they treated under the CITA?
That's a new deductible, but there are some regulations to make sure that the funds are really there, and not that they just make provisions for them in the books. Because basically, for companies that are not mindful of that obligation in the past, they have to now provision for it, and then they have to put something, the money in a bank, and then there should be evidence that provision has been made for it.
Thank you very much. The next question is, how does the new tax law affect us as legal practitioners?
Well, basically, we are impacted by income tax and also by withholding tax, which is an aspect of income. So for the small firms, where the turnover is not up to 50 million, no, not 50 million. For small firms where the threshold is, I don't know any law firm who can fall below threshold. So, but we are totally free. They will be totally free of withholding tax obligation if the withholding tax, if the turnover is not up to 50 million, because withholding tax is the albatross for many businesses. So when you are transacting, you really do not, you are not aware of the implication. But for us as lawyers, if our taxes have been withheld under the new withholding tax regulation 2024, the process of getting credit for the tax withheld is now easier. As a matter of fact, even if the person who withheld failed to remit, that still will not prejudice claiming it as credit. So that is favorable for us. Then there is relating to VAT. Relating to VAT, we need to now position ourselves to get the benefit of the provision on refund, and also the provision on claiming the input VAT. I mentioned it in the course of my presentation. At the moment, most lawyers don't even understand how VAT works. And then ideally, every lawyer should be agent of collection. It means when you are billing your client, you are supposed to put 7%, 7.5% on top of it, collect it from government. But a lot of people will say that is going to make them uncompetitive. But whether we like it or not now, if government sorts out the legality of VAT, they are likely to come after us. So I would encourage lawyers to register, and then so that they will be able to deduct whatever input VAT they pay on their own consumables. For example, if I buy a laptop and I pay 7%, I bought chairs and tables, I also paid VAT. I bought my wig and gown, I paid VAT, because you can claim input VAT on even capital expenditure. So that's a huge advantage in my view. And I will encourage us to pay attention to now see what is in it for us in terms of real value.
Okay, thank you very much. Closing link to that.
Then sorry, we need to keep accurate records. We need to keep accurate records, and I would suggest that an average law firm should have an accountant, because when the tax men come, even for not keeping record alone, there's a, I reeled out a couple of administrative penalties. So at least because they are still part of the law, and until maybe there is an adverse judicial pronouncement on them, the tax authority can give us can ask us to pay penalty, and some of these penalties are not they are not friendly at all. So we should try as much as possible to be on the wrong side
To be on
and
the right
do
side.
what we have to do. Yeah, do the right thing.
Yes, thank you very much. Closing link to that is the question saying that based on the information gathered, does the VAT rate of 7.5% still cover till end of the year 2025, or has changed to 10% and effective immediately? Kindly assist to provide clarity.
So sorry.
There is no increment.
moderator.
Okay, Lola,
Lola,
you want to
Yeah, I
mock
just
in?
wanted
Yeah,
to,
please go
I
ahead.
wanted
Yeah.
to just add to what Prof said about how, in response to how the new tax laws affect law firms. Also to add to what he said, you also need to look at the payee, your payroll and your payee administration for your lawyers, for your associates. As Prof shared, the rules have changed. You no longer have consolidated relief allowance, and the thresholds have changed. So to that extent, you need to look at the salary scale of your employees and make all the necessary adjustments. But that will not take effect until 1st of January 2026. That's just what I wanted to add to that.
Thank you very much, Lolade. The next question is how do legal practitioners decide what tax to pay and tax reliefs available? I think that's closely linked to what you have explained.
Yes, and I've also highlighted and simplified the taxes. You now have 5 taxes, for God's sake. The first one, when you make money. The second one, when you spend. Another one, when you generate instruments. And there are a few of them, like before, when you can't really determine. So development levy does not relate to us as individuals. Then surcharge, when you buy fuel, so that when there is agitation against this surcharge, you can also let your voice be heard. Then relating to keeping our books and also doing our PAYE, if you need help, ask. There are tax firms who can provide some of these services at modest fees. So thank you, Fred. Yeah.
Thank you very much, Mananesu. The Google form is now available on the chat platform. So please click on it and fill the form, so that you can get your CPD points. Is available there. The next question is it says that NTA exempts small companies paying company income tax, but excludes companies providing professional services. So does this definition include or extend to hospitals and clinics? I think this is a legal practitioner.
For us as lawyers, we hardly carry out our practice under a corporate name. I was even surprised when I saw Glimpses Limited. And I want to ask, well, what advantage does that give the company? So maybe Femi can speak to this, because you expose yourself to higher withholding tax rate and all that. But anyway, that has been streamlined now. But before now, the basis of carrying on professional practice under a limited liability company or even limited liability partnership is remarkable in my view. You understand? So,
yeah.
But if you have hospitals, Eco Hospital, the Lagoon, all these are limited liability company. But unfortunately for them, they're above the threshold. But if the books and everything shows that the turnover is not up to 50 million, it's not a big concern to the tax authority. The new revenue service will not bother about them, but they still have obligation to file returns. And then failing which, there will be penalty.
Thank you. Thank you very much. I guess most people would, like it's done abroad, they would seek the service of accountants and tax professionals to help them do their tax computation and advice on how to manage their books so that they don't run foul of the tax laws. Because like you said, the penalties are quite punitive. The next question. Good day, sir. Please, is consolidated relief allowance still in operation for the purpose of payroll preparation with the new PIT rates? I think Bolade has addressed that, or do you?
I think I mentioned it in my presentation, and I
Yes.
showed the table. I said, look, for most people, unless somebody is earning above 10 million or so, you know, your consolidated relief allowance may not even be up to that 800,000. So if 800,000 is already exempt, there is really no basis for consolidated relief allowance. So that is now in the past, and it is inferior to what we have now. Consolidated relief allowance no longer forms part of the corpus of our tax laws. So we need to now familiarize ourselves with the provisions of the new tax act, and then all the concepts that are going to emerge under it.
Thank you very much, sir. Lola, they have some questions for you. It says, how has Nigeria benefited from international tax institutions in shaping its tax system?
Oh, the benefit has been quite immense. Before our involvement in the OECD inclusive framework, Nigeria was pretty much in the dark about a lot of the tax avoidance instruments that were being used for tax planning. So it helped us the framework. We had the 2012 transfer pricing regulations. That was even first that Nigeria would issue regulations to govern any aspect of international tax. Before then, all we had was an FRS information circular on taxation of non-residents. So, but since our involvement in the OECD, you could see, like I said, from the things that started to appear in our finance acts and, you know, all the various regulations that are coming up, that Nigeria was now very clued in on what was going on. And so to that extent, it has really opened us up to addressing cross-border transactions. Of course, there's still a lot to be learned by us, and a lot of understanding also needs to be conveyed to our tax adjudicators as well, as in all jurisdictions, really, because of the digitalization that is going on. Business models are changing very rapidly, and all over the world, tax authorities are working relentlessly to catch on with what is happening. But Nigeria is one of the nations in Africa, of course, coming after countries like South Africa, Kenya, Rwanda, Ghana, to also catch on to these things. So it's benefited us to that extent.
Okay, thank you very much. Let me ask you the second question. What institution in Africa has played pivotal roles in shaping international taxation with emphasis on the continent or regions within the continent?
Very interesting question. Do you know that until recently, there was none? The United Nations has been the one holding brief for developing countries, of course, including African countries. But, you know, recently, the African Union has now seen the need for them to establish a tax committee. Prior to, I don't want to say the wrong date in public, I need to go back and check, but I can tell you that at least as of the last 3 years, African Union did not even have a dedicated department, keeping track of international tax developments and how you have the African Union playing a bigger role. I just mentioned that they've joined the OECD Inclusive Framework, which is a good thing. But on the administrative level, you also now have ATAF. ATAF is the African Tax Administrators Forum. And then you have WATAF, which is the West African Tax Administrators Forum. So increasingly, Africa is getting more involved. And Nigeria in particular is very involved in the conversations that are happening at the UN level, and was also very involved in the OECD Inclusive Framework Task Force on Digitalization. So things are, the revolution is on.
It's on. It's
and we're
on,
part
yeah.
of it.
Thank you very much. Professor Sonny Essien, there's one question for you here. It says, how are you going to eliminate multiple taxes? It says 60 taxes, which I think are more than that, across the states in Nigeria. We heard the committee has asked for constitutional amendment. What is the status?
Well, that is the part of the committee's work that is still in progress. So for that, I would say work is in progress. Remember, I said we should appreciate the limitation of federal tax reform. Because if you are in a federal system and the matter relates to local government, so no matter how well-intentioned the federal reform may be, there is an extent to which it can just not sweep aside issues relating to subnationals. So you can see the way the governors fought back on the issue of VAT. So, and that is why I called for state tax reform, because until and unless we have intervention by the state houses of assembly, some of these issues are likely to linger, because issues of multiplicity of taxes had started before I even came into taxation. And then we are still talking about it. And you can see that even at the federal level, rather than abolishing special taxes, we are putting them in a bucket and we are calling it development levy. So right now, federal government is saying, state and local governments, stop all those nonsense. But on its own, it wants to continue and then give it a new name. So does that show seriousness? It's one aspect of this reform that I'm not really proud of. But people should recognize that these are issues that are far beyond the committee.
Thank you very much. Sir, can you just give us a final word, 1 minute?
Well,
rounding up.
My final word is take this as the beginning of conversation. This reform will give us a quantum leap, but I'm not going to be, I will be circumspect in saying that it is going to be revolutionary, because generating lots of money is one thing, then spending it in an accountable and transparent way is another thing. So if we generate much more and then people see less in terms of development, rather than seeing development, there will be retrogression and frustration. And then for lawyers, we need to move beyond talking in terms of general principles, general provisions, and pay attention to the actual provision. Therefore, virtually everything I said, there will be cross-reference to the relevant provision. So you need to do some heavy lifting yourself. Then watch out for more robust and more detailed training, so that as soon as you see some of them, then be part of it. CITN is undertaking, I think, a free training at the moment. They've been doing it for about 7 days. So if you can be part of that, it's really going to be beneficial. So once again, thank you so much for this opportunity. Have a good day, everyone. Bye-bye.
Thank you very much. Lolade, please, could you give us a 1 minute roundup?
Thank you very much once again. Like Prof said, we hope that with what's going on, as government makes more revenue, we see the impact on the society. And I would just say that revolution has two sides. Revolution, you can have a revolution, a positive revolution leading to positive developments. And you can also have a revolution that comes out of people feeling oppressed. And it's interesting that a lot of the revolutions that we've had have been centered around tax. The Aba Women's Riot was centered around tax. The Funmilayo Ransom Kuti revolt was centered around tax. So when government begins to tax and tax begins to pinch and people cannot see the reward of that tax revenue, that can trigger a different type of revolution. But I hope we don't get there in Nigeria. And to my learned colleagues, I just want to say that, as I said, there's a bigger and a revolution that is broader in scope that is happening globally in relation to tax. And I'd like to just encourage us to also understand, to see certain provisions in our tax laws. We understand where it's all coming from. And finally, also to those of us who have the privilege of adjudicating on tax matters, it's very important as we adjudicate on tax matters to understand the evolution that is going on in the changing ways by which companies are doing business. The digitalization revolution is another one we should be mindful of and be careful not to drive away investment from our region, but instead to use tax to provide an enabling environment for such business models to grow. Thank you very much to the organizers.
Thank you very much, Lolade, and my learned professor. Thank you so much for giving us this insight today. I'm sure we have gained a lot of knowledge from this training. Thank you, Glimpse Limited. We know you'll be doing more. Glimpses Limited, we know you'll be doing more on this. Like Professor Sonny said, we have just started. The first step is what has been done, which is the revolution is starting with moving taxes away from the poor onto those that can afford to pay taxes, which are those that are richer. And that's one of the things the tax law has done is to reduce or lift the threshold for taxation to those that are able to afford it. I think enforcement now is on the fiscal policy, which is on the implementation. What do we now use this money is taken from tax? What do you use it for? There's a lot of responsibility on the states and local government and the federal government on the expenditure. That is where the people now have to ensure and put pressure that they have the right people in place and that government uses these funds for the benefit of the people. As lawyers, the tax environment is changing. We need to update ourselves. We need to participate. As many more people are involved in paying taxes, there will be tax disputes as we have new laws. We need to keep ourselves abreast and be able to assist our clients. Like we have been told, the tax appeal tribunal is there for anybody that feels that the tax authorities are not being fair unto them. The tax tribunal can help to work on those things within a minimum of 6 months. And if not satisfied, you can go to the Federal High Court. So thank you very much for participating in this seminar, and hope to see you when the next one comes up. So I want to say a good afternoon to you all, and a thank you to our speakers. Thank you very much. Have a good afternoon. Bye for now. And say thank you to Glimpse Limited, Femi Oedipe. Thank you so much. Bye. Have a nice day. And make sure you fill your forms so that you can get the CPD form, CPD points. Thank you very much.